Everybody wants to invest in AI, but the biggest AI startups still aren't public. You can't buy OpenAI in your brokerage account. You can't buy Anthropic. And xAI? On February 2nd, 2026, SpaceX acquired it. So that's private too. So the question is, how do you make an AI trade today, when the crown jewel startups are behind a velvet rope? Here's the punchline of this whole video. You stop trying to invest like a venture capitalist, and you start investing like a toll booth owner. Because the public market isn't missing the AI boom. The public market is where the AI boom is being paid for. Today I'll break this down in 3 parts. 1. Why the model companies are staying private and why that changes your strategy. 2. The 3 public market AI baskets I want you to know: clouds, chips, and kilowatts. 3. The main ways retail investors can still get private exposure and the traps that can turn AI investing into AI pain. So why can't you just click buy on the biggest AI companies? OpenAI hit a roughly $500 billion private valuation in an employee share sale in late 2025, still not public. And just to show you how fast this is moving, reports in late 2025 and early 2026 have suggested OpenAI has explored fundraising that could value it dramatically higher than that. Anthropic is the same story. Huge scale, huge funding, still private. In fact, Anthropic just announced a $30 billion round, valuing the company around $380 billion post-money. And then we have the wildest example: SpaceX acquiring xAI, a deal that multiple outlets describe as creating a roughly $1.25 trillion private giant. So why is this happening? The simplest answer is, the IPO is no longer the main event. These companies can raise gigantic rounds privately. They can do secondaries for employee liquidity privately. And they can strategically partner with the biggest public companies in the world. In AI, those partnerships often look like this. A cloud giant invests in a model company. The model company commits to buy tens of billions of dollars of compute from that cloud giant. And the investment comes right back as revenue. It's a loop. For example, Microsoft, NVIDIA, and Anthropic announced partnerships where Anthropic committed to purchase $30 billion of Azure compute capacity, while Microsoft and NVIDIA plan to invest in Anthropic. So for public market investors, here's the key takeaway. The pure model layer is mostly private. But the constraint layer, the stuff that has to be built and paid for, is largely public. And that means your best public market AI trade usually isn't which model wins, it's what does every model need? Which brings us to part 2. If you want a simple mental model, public market AI investing is mostly a bet on bottlenecks. What's the constraint? Cloud capacity? Chips? Electricity? Cooling? Enterprise adoption? Answer that question and you can build a trade without needing access to private shares. Let's go basket by basket. Basket number 1. Clouds. This is the toll booth trade. Even if you can't buy OpenAI, you can buy the highway OpenAI drives on. Training and serving models at scale requires data centers, networking, storage, security, deployment, and enterprise distribution. The hyperscalers sell that as a service, and they get paid in recurring bills. Here's the simple idea. Models compete, cloud invoices get paid. Microsoft is the obvious example because of its relationship with OpenAI. Amazon is another because it has invested billions into Anthropic and tied the partnership to AWS and its Trainium chips. Google has also expanded its relationship with Anthropic, including large cloud infrastructure agreements around TPUs. Now, the nuance. When you buy a hyperscaler, you're not buying an AI pure play, You're buying a giant, diversified business. So your AI thesis needs to be specific. Are you betting that AI increases cloud demand? That AI improves margins through productivity? That enterprise customers pay more for AI add-ons? Or that AI becomes an arms race that compresses margins? All four can happen depending on the year. That's why I like clouds as a core exposure idea. It's a diversified way to be right about AI activity without needing to be right about the winner. If you don't know which model wins, own the road they all drive on. Basket number 2. Chips. This is the picks and shovels trade. AI is not limited by ideas. AI is limited by compute. So the chip stack matters. Accelerators, foundries, manufacturing equipment, networking, and memory. Let me translate that into plain English. If you think AI keeps scaling, you can express that view through chip designers like GPU and accelerator companies, foundries that manufacture leading-edge chips, equipment companies that enable advanced manufacturing, networking companies that connect thousands of GPUs into one giant cluster, memory companies that supply the high-performance memory those accelerators need. And memory is an underrated bottleneck. High-bandwidth memory, HBM, is a key ingredient for modern AI accelerators. It's difficult to scale, and demand has exploded. Micron has said that HBM and other cloud-related memory went from a small piece of its DRAM revenue in 2023 to about half by 2025. And the company has projected major growth in the HBM market over the next few years. When a component becomes the bottleneck, pricing power often follows. But the chip basket comes with risks you have to respect. Risk number 1. Semiconductors are cyclical. Even in megatrends, chip stocks can overshoot on the way up and overshoot on the way down. Risk number 2. Customer concentration. A handful of hyperscalers drive a huge chunk of AI infrastructure demand. If those CapEx budgets slow, the supply chain feels it fast. So for a lot of investors, the practical version of the chip basket is not trying to pick the one perfect winner. It's using a diversified semiconductor ETF as a way to participate without a single stock blow-up. Okay, third basket. Basket number 3. Kilowatts. This is the physics beats PowerPoint trade. AI runs on electricity, and AI data centers are not a little more electricity. They're a lot more. The International Energy Agency projects electricity for data centers could grow from roughly 460 terawatt-hours in 2024 to over 1,000 terawatt-hours by 2030. And in the US, one widely cited projection from Lawrence Berkeley National Lab, referenced by Harvard's Belfer Center, suggests US data center demand could rise from 176 terawatt-hours in 2023 to somewhere between 325 and 580 terawatt-hours by 2028. That's not just a tech trend, that's a grid challenge. So the kilowatts basket is really 2 trades sitting on top of each other. Trade 1, power generation and utilities. Trade 2, the inside the data center supply chain, power distribution and cooling. We're already seeing power deals that would have sounded insane a few years ago. Constellation signed a 20-year agreement with Microsoft tied to restarting 3 Mile Island Unit 1, now branded the Crane Clean Energy Center, to supply carbon-free power for Microsoft's data center needs. And Meta has announced multiple nuclear energy deals to support its AI data center expansion. This is what it looks like when a tech company starts acting like an industrial company. Reliable power becomes a competitive advantage. Now let's talk about the part most people miss, the plumbing. Even if you magically had infinite electricity, you still have to get that power into the building, into the racks, and keep the hardware cool. That means transformers, switchgear, UPS systems, busways, cables, and increasingly, liquid cooling. As racks get denser, air cooling starts to fail. Liquid cooling is accelerating. Vertiv, for example, has worked with NVIDIA on liquid cooling reference architectures designed for extremely high-density racks. And if you want one more signal that kilowatts are the constraint, regulators are starting to respond. Texas, for example, passed Senate Bill 6 to create new rules for large loads like data centers in the ERCOT region, shifting more interconnection costs and reliability obligations onto those large load customers. So if you believe AI keeps scaling, the kilowatts basket is basically a bet that we will spend on power and infrastructure, because we have to. All right, at this point, a lot of people say, okay, that makes sense, but I still want private exposure. I want the OpenAI type upside. Totally fair. Let's talk about part 3, how retail investors can get private exposure and the traps. There are 3 main routes. 1. Exchange-listed closed-end funds that own private companies. 2. Interval funds and mutual funds that hold private shares. 3. Private secondary markets, usually for accredited investors. Route 1. Exchange-listed closed-end funds. The poster child here is Destiny Tech 100, ticker DXYZ. The pitch is simple. A publicly traded vehicle that owns a portfolio of private tech companies. The catch is also simple. Closed-end funds trade like stocks. Their price is set by supply and demand, and that price can disconnect violently from the fund's net asset value, or NAV. Morningstar highlighted that DXYZ traded at moments where investors were effectively paying around $20 for a claim on $1 of assets. So here's the rule. Before you even think about buying a closed-end fund for private exposure, check the premium or discount to NAV. If you're paying a massive premium, you are not buying SpaceX. You're buying a premium and hoping someone pays an even bigger premium after you. That's not compounding. That's musical chairs. Route 2. Interval funds and mutual funds with private holdings. Interval funds don't trade on an exchange. Instead, they periodically offer to repurchase shares at NAV, often quarterly, but liquidity is limited. A high-profile example is ARK Venture Fund, ARKVX. ARK is explicit that shares are not exchange-listed and that investors should not expect to sell except through the fund's repurchase policy. And ARK's published holdings include large private names, including SpaceX and xAI, alongside public stocks and cash-like positions. So what are the trade-offs? Trade-off number 1. Fees. These products can have meaningfully higher expense ratios than a plain index fund. Trade-off number 2. Liquidity. Quarterly repurchases are not the same as, I can sell whenever I want. In stress periods, you may not be able to redeem everything at once. Trade-off number 3. Valuation. Private assets are not continuously priced like public stocks. They're marked periodically, using models and comparisons. So the NAV can lag reality, for better or worse. Mutual funds can do a version of this too. Barron Partners Fund, BPTRX, is often cited for meaningful SpaceX exposure. But again, concentration, fees, and volatility matter. And I'll add one personal finance point here. If you're going to use any of these private exposure wrappers, think of them as a small satellite position, not the core of your retirement plan. Route 3. Private secondaries. This is the most direct way to buy private startups, buying shares from employees or early investors. Platforms like Forge and Hive exist to facilitate those transactions. But most of this world is built for accredited investors under SEC rules. Even if you qualify, you need to understand transfer restrictions, the fact that spreads can be wide, and the reality that you can be locked up for a long time. One interesting development. Barron's reported that Charles Schwab agreed to acquire Forge Global to expand private market access for clients. That doesn't mean private markets become easy or safe overnight. But it does tell you something. This public-private divide is turning into a product. Okay, now let's land the plane. How do you actually make the AI trade today? Here's the framework I use. Step 1. Define the thesis in one sentence. Not AI will be big. Something like, data center power is the constraint, so utilities and infrastructure benefit. Or, compute remains supply constrained, so the chip stack keeps pricing power. Or, model adoption drives cloud demand, so hyperscalers capture the spend. If you can't say it in one sentence, you don't have a thesis, you have vibes. Step 2. Choose the cleanest instrument. If your thesis is chips, use a chip basket. If your thesis is power and cooling, use the kilowatts basket. If your thesis is private exposure, use diversified vehicles, and be allergic to huge premiums to NAV. Step 3. Match the position to your time horizon. Compounding positions need strong balance sheets and staying power. Shorter trades need clear catalysts and strict position sizing. Step 4. Respect the biggest risk in the AI boom. Return on capex. AI is consuming massive capital, chips, data centers, power, and the world is still proving out sustainable business models. If the ROI shows up, the infrastructure winners can keep winning. If it doesn't, you can get a capex hangover. And that's why I keep coming back to toll booths and bottlenecks. If you don't know which model will win, own what every model needs. Before we wrap, 3 quick things I'm watching this year. 1. The pace of long-term power deals and grid regulation. When states start writing rules for data centers, that's a sign the power constraint is real. 2. HBM and networking supply. If the bottlenecks stay tight, that supports the chip basket. 3. Any real IPO filings from the mega AI companies, that could reset sentiment and reprice the wrapper funds overnight. Alright, bringing it home. If you came here looking for the next OpenAI stock, I get it. But in public markets, the smarter play is often the boring one. Own the toll booths, own the shovels, own the bottlenecks, clouds, chips, kilowatts. If this was useful, hit like, subscribe, and comment which basket you want me to break down next. See you next week.